do that. Good morning, everybody. Hope you're doing well. I live in a cafe. Yes, I live in Ceres in Chicago, right next to the CME. I am under the bar. It's where you will find me. Good morning, Lyndon. Good morning, Billy, BS, Donley, Les, Alex, Rosario, Erica Northport. Good to see everybody. Randy, hello. We got a lot to cover today because, well, it's Tuesday. We are heading into earnings season. It's momentum. It's holding on. It's holding on. It's doing its job. Right now, as we look across the bow, futures 6,800 on the S&P 500. Looking at Palladium, hey, PALL, who's on Team Pal. We had 121 on the PALL, big rebound recently. Watching copper bounce around. Remember, I talked about this yesterday. This is all about China, and gold hitting 4,000 for the first time. Hey, L. Sesser. Hello, L. J. Lesser, forgive me. Wow, that's terrible. GM, watching her chase the stroller down the hill in about 30 minutes will be very fascinating. I agree with that. And we're also going to find out who owns that Tesla that's been sitting there. I swear they're watching me. They're watching me. It says that it is a student driver. I don't believe that. I think it's somebody else. You really learn a lot about your neighbors in a very short time, but that is what we do when we are not trading between 9:30 and 4 o'clock. Just look out the window like a cat and see the world for what it is. NASDAQ hitting 25,219, the Russell at 2,500, and the VIX holding at around 17.5. So today we're going to talk about momentum, where we sit right now, the runner at 9 o'clock. And then we're going to talk about the money markets because, wow, there was another article. Wow, that was a terrible impersonation of whoever that was. Let's talk about the money markets because there's a huge misconception here that I think a lot of people need to understand, and it will help you understand what is actually occurring in the financial system with $7.7 trillion in money market funds. Wow. Yeah, Walken, thank you. That was not what I tried to do, but hey, that's free. That's what you get with your free ticket every single morning here at Market Masters. All right, everybody. So what are we talking about today? We talk about the stocks that are actually engaging and trading today. We had some big moves on the runner in the last week and a half. We'll talk a little bit about that because, once again, we give this away for free at 9 o'clock every morning. There is a ton of value in this when we talk about the stocks that are breaking out and breaking down. We talk about momentum, about the safety of the markets. And it's interesting because people ask questions all the time of, well, I don't know what to do with this information if it's just green all the time. I agree. That's just been the reality of the markets going back since April. We are in this melt-up scenario. There is tons of money sloshing around. There's no liquidity event transpiring at the moment. So therefore, if it's green, stay bullish. Unfortunately, I would love when the markets sell off. I love to be able to take advantage of a big decline in the S&P 500. It has not delivered. But when we are green, we are still dancing, but we are keeping our eyes on the door. We'll go through some stock screeners, stocks, and trade strategies for the day. All right, so as you know, every day we start our conversation. Good morning, Mountain Mike. We start our conversation with momentum. So again, what do you do when this is red? Well, you get out of the way. You move to cash, you move to the SH, you look at some of the short funds. But the reality is momentum has remained strong since April, and that is evident in that SPY chart, right? It's evident in the SPY chart. And we're going to jump over to Thinkorswim in a moment when we go through the runner stocks. But I just want you to pay very close attention to this gray line. That is the 20-day moving average of the S&P 500 SPDR ETF. It is a reflection of the S&P 500 and momentum returning back to this market around April 24th of this year. That was where algos turned back on May 1st when we crossed above that 50-day moving average. That's where a lot of leverage turned back on. And we're going to talk about that when we discuss the money markets to explain what is actually going on when $7.7 trillion is quote unquote sitting on the sideline. Spoiler alert, it's not actually on the sideline. All right, so when momentum is negative, we move to what is called the FNGD. The FNGD. I know it sounds like I'm cursing. I am not. I am not yelling at my dogs. I am just simply pointing out how leverage operates in the financial system. The FNGD is a leveraged exchange traded note. Don't worry about what it does. Don't worry about the fact that it's leveraged. Don't worry about the fact that it's inverse. Don't even think about it. The only thing that matters is whether or not this thing is above or below its 50-day moving average, because when it is above its 50-day moving average, something is wrong. Something is typically wrong in leverage and credit in the financial markets. That leads to an unwinding of positions in bond markets, in equity markets, and that's how you end up with a big downturn like we saw in April, or last year's crash on the Nikkei, or the crash during the gilt crisis in 2022, or the biggest hedge fund sell-off in 15 years in June 2022, or, okay, you get the point, COVID, right? So we're positive. Money's sloshing in. We have $188 trillion in global liquidity right now, $338 trillion in global debt. That money goes somewhere, and it goes into risk assets. And it's one of the reasons why we are seeing gold at 4,000. We are seeing silver near 50. We are seeing Bitcoin at 125,000. Okay? It's not that complicated. A lot of money sloshing around, finding its way into risk assets. Green, green, green across the board on the Russell, on the NASDAQ. Again, as I pointed out the other day, Russell 2000, junk stocks on the Russell 2000, unprofitable companies that should be bankrupt, are outperforming small cap value. Okay? So companies that actually have real fundamentals are underperforming stocks that are unprofitable zombie stocks that should not be in business anymore. But the beauty of the financial markets post 2008 is that it doesn't matter. What really matters is whether or not you still have enough room on your balance sheet to borrow. And if we're going to cut interest rates, that's going to continue. So continue to keep an eye on those key moving averages that we discuss, the EMA 8, the EMA 20, the EMA 50, and look for those junk stocks from time to time periodically to lead to squeezes. We had the second largest squeeze week last week of 2025, and nothing significant happened. That is where we are. But as we note that, it would not be a morning if I didn't raise some concern about the financial markets and the silliness that it involves. Secret Agent Charlie's here. Good to see you, P. Butts. Cubs are about done. This is going to get, it's one of those things where I already know what's going to happen with the Cubs. I was a Cubs season ticket holder. Don hates that. Cubs season ticket holder from 2006 to 2017. And in 2015, when they lost game 4 to the Mets, I sat behind a pole in Wrigley Field. No one cheered the entire game. That is what will probably happen tomorrow. You will not hear a sound the entire game. So they have to win in a quiet Wrigley Field, and then they have to somehow pull off game 4. All right, so fund stress versus equity resilience. This is actually pretty critical. So Goldman Sachs reporting that systematic hedge funds, suffered daily losses through October. That indicates momentum trade exhaustion. Okay, so what does this mean? Well, it means that we could be approaching an inflection point, either a melt up where these funds have to keep chasing or a sharp unwind in these positions. Despite all the positioning stress, the U.S. indices continue to push higher thanks to the AI trade, rate cut hopes, liquidity, passive flows, money continuing to pour in. But as I've noted, there will be about a $300 billion, according to cross-border capital, outflow in liquidity in the next 9 months that can cause some issues. We're expecting liquidity to effectively stall in the fourth quarter. That can lead to stagnation in positioning, look for profit taking. And as we will get into December, as I will explain during the money market concept, we are looking for a potential downturn in the markets. We'll explain, because money leaving the money markets leads to outflows. The question is, where does that cash go? Well, spoiler alert, it moves right back into the money markets. What are traders should be watching right now? What are traders should be watching? That's great. I went to college for journalism. Good job, Garrett. Mega cap breadth are new highs supported by wider participation, or is it just going to be the top names? NVIDIA, Broadcom, AMD too. Why not? Gold and bond inflows. The rising haven demand could precede an equity pullback. Look for large block trades in the SPY and the Qs as sign as institutional positioning shifts. And any news of fund redemptions. Very important. One blow up can cascade across trend following strategies. One fund that needs all of a sudden to that gets its margins called, that can lead to counterparty stress. That can lead to a quick unwind. Once again, we'll keep a very close eye on momentum and, of course, inform you if there are any changes in the current state of affairs. Oil's bouncing back after OPEC made a pretty fascinating little call this morning. So looking at the USO, Occidental, OXY, after that deal with Warren Buffett last week, Exxon, British Petroleum, and CVX. I don't think it's called British Petroleum anymore. I think it's BP. I think they changed the name after the oil spill. OPEC Plus, right, approved a modest production hike of 137,000 barrels per day starting in November. That's actually below where expectations were. There were some expectations it could be up to 250,000. Energy equities and refineries tend to react quickly to the perceived tightening or loosening of supply chain trends. So obviously, keep a close eye on those key moving averages around Exxon, on Chevron, some of those other core names. Can WTI push and sustain above key resistance levels? That's going to be the big question. We are not coming out of oversold in any capacity. That's one of the major things that I want to point out. Always look at the OILU. This is the leveraged ETN around energy, upstream exploration and production. Yeah, I know it's a mouthful, but there is no ETF fees taken out of this thing. It is a pretty pure reflection of energy at the moment. We are sitting here right above our 20-day moving average on the OILU. So as a result of that, we look at companies like Devon Energy. And if we are breaking above these key levels, if we can get momentum, a buy at the 35 level and a sell at the 36 level, short duration, maybe next Friday, maybe even this Friday, would be a unique little trade, just looking for a little bit of covering, a little bit of strength and momentum. And again, just keeping a very tight stop just in case we drip back under the 20-day moving average. If you're going to take a shot now, but keep your stops tight. Earnings or forward guidance from producers will be coming up. A lot of focus on CapEx and pricing assumptions. A lot of focus on whether or not they're even hiring. Remember, the energy sector had been one of the strong spots of this economy for the better part of a decade. And then all of a sudden, things dried up in 2014 after the Bakken oil boom. We will see if there is strength in the engineering space here, if there is strength down in the oil fields. But for right now, we're continuing to see a little bit of perceived weakness, and we could be obviously shutting down more rigs if energy prices are under stress. Remember, demand signals from China and U.S. inventories will continue. Any weakness could reverse sentiment. And energy markets, it's always best to be focusing on overbought and oversold. But if you are trading around key moving averages, be cautious and just simply set tight stops, looking for momentum to continue in one direction. Finally, global bond FX and bond volatility. Look, we have geopolitical risk back in focus. There used to be a time when these types of things would send the markets into a tailspin. There was also a time when a crazy person would fire a missile into the Pacific and the S&P 500 would fall 4%. That doesn't happen anymore, largely because of the massive amounts of capital sloshing around and all of the algos talking to one another. But it is important to note that France is a dumpster fire right now, entering its fifth leadership change in less than 2 years, rattling markets and pressuring sovereign spreads. This impacts the European Central Bank, impacts their monetary policy, which in fact ends up impacting our monetary policy here in the United States. Why does this matter? Well, once again, as we have noted, the ECB is an interesting place if you study it from an academic perspective. I'm not telling you to actually do that. Don's already falling asleep when I brought that up. The point is that you have 28 nations operating under different tax strategies, different tax rules, but one monetary policy. So the ECB will likely provide some sort of support to France, given the fact that it is a massive part of the European Union. But if Italy needs help, they won't help. That's just kind of the way that it works. So as we look at this, just keep a very close eye on this, because something could obviously happen in one of the banks in France that can spill over into Europe, which can obviously spill over here. So keep an eye on this. If the European Central Bank starts to accommodate in any way, that is bullish. That is bullish for global equities. It's bullish for everything. It's more money in the pipeline, more money pushing equity prices higher. Japan, with the new prime minister, supports fiscal expansion and dovish central banking policy. Bullish for equities, bullish for banks, bullish for those Warren Buffett investments in Mitsubishi and those other names, but bearish for the yen. Keep a close eye on the US dollar. Traders are repositioning aggressively in the RX and rate markets, expecting more policy intervention. As I have said, Japan remains a problem. It was a problem last year, particularly for the Nikkei crash that happened last August that took our equity markets down sharply. Recently, I thought that there was a lot of problem in the U.S. regional banking space, but there obviously were problems as well in the Japanese markets as well. Do a little bit of intervention. Keep an eye on the USD, the USD JPY, and bond spreads in France and Germany. Again, we are just looking for some sort of event that people can't say, hey, this came out of nowhere. Japan or France are major economic powerhouses, and their sneeze can lead to a global flu. All right, we're going to talk about the runner. Yeah, we are. Haha. Well, let's just talk about this very briefly. Okay, PCT, which we named yesterday, third on our list, Pure Cycle, 8% move yesterday. Okay, so don't tell us that we're not coming up with good ideas. AMD, Friday, first stock on the list. Well, that happened yesterday. Well, you know, some people bought that 167.50 spread and 170, and I really want to thank those people yesterday for saying, hey, Garrett, we made 150% on that trade. That's what I want to hear. What I don't want to hear is the other guy going, well, we should have made 2,500. Look, I'm just giving you the name of the stock, and I'm giving you a trade that you can double your money, hopefully. But as we saw with AMD, guys, it broke above these key moving averages. It showcased strength and momentum. And there it went. It just took off. And suddenly it seems that somebody knew something. Somebody knew something because the bets came in on Friday and the markets reacted on a Monday. AIG, another name. And we've talked about this. This is the stock that is the big warning signal for liquidity events in the financial system. We came back last week. We talked about it, AIG. It's up 6.5% since October 1st. It has had a nice little positive run. Eight breaking above that 20-day moving average. That's exactly what we are looking for. All right, so on today, as we dig into this, we have strength in Boeing, Bird, and TPL. Let's take a quick look at this real quick and pull this up. So we got all three of these stocks lined up in a nice little row. Look at that. He's learning. He's learning how to use the internet. There's your key moving average. Look at the one in the center. That is your 8-day, 50-day, and 20-day EMA. Your 50-day on Bird is the red line, but you can see strength returning to these names. Boeing coming back up above that 219 level. We see Bird. I don't understand that stock. That stock doesn't make any sense to me. Bird. Is that all birds? It is. Isn't that shoes? Why not? Who cares? Shoes. Let's bet on shoes. Bet on bootstraps. Birds launching the first ever waterproof wool sneakers, marking a major product launch. That would make Bernie Sanders very upset. To have sneakers made of wool, you could have made sweaters, could have made shoes. They're not going to like it. All right. Bird. What can you do with Bird? Well, let's take a look. Option profit calculator now. Can't use that. We need to dig deeper into some other tools that we have. Let's try to figure this out. Is there even a good, decent option chain on Bird? Who knows? We're going to find out. We're going to find out. I don't want to dig too far away from this. BA. Let's start at BA. So Boeing on your left, obviously, bouncing right here, 218. And what I want to do is I want to add the 8. Oh, I can't even see that. Well, I'm blind. One second. What a nice white line. Nope, that's not white. Cool. This is what you signed up for. All right. Pushing 820, 219. All right. What can we do with Boeing? Possible move back to that 240 level? Hopefully, maybe. We'll see. I just like staying in the money and keeping it short. 217 call for next Friday and selling the 225. Okay. So 217, 225. What does that give you? $335 to make 415, 51% probability of profit with a break even right at the 220 level. Okay. So what you're looking for, very simple. You're looking for a continuation of that break on that 8-day moving average and lifting Boeing with it. If you buy the 215 for 217.50, forgive me, for next week, that should cost you somewhere around $650. But if you write the 225, which is around $3.10, $3.15, that spread will cost you about $335. You only need to buy one of them. You're going to set a very tight stop back at around the 218 level for Boeing. If Boeing falls back to 218, you're out. And you would lose about 41%, forgive me, which is about a 12.5% loss. But if Boeing continues to run, if Boeing can get to 224 by tomorrow, which is entirely possible, then you're going to be up around 30%. If Boeing runs into next week and we get up into that 223 level and we expire next Friday, it'd be a 64% gain. So once again, next Friday's 217.50 call. Okay. Well, we're going to hold off right now. We're going to figure it out. We're going to do it. Nah, no, we're not. We're not going to figure anything out. BA, let's just go it this way. It's fun. It's great. It's great. Charts. There we go. There you go. Better? Good. All right. BA pushing above this. 218 becomes your line in the sand. And once again, 217.50 for next week, but selling the 225. Right? 225. If you want to reduce the trade a little bit and not have it be $325, you could sell the 222.50, and that would be about a $250 trade. And what you're looking at here is a $242 to make 258, about 100% return, and your probability of profit goes up to 54% because your break even is actually right back at around that 20-day EMA. Pretty critical. All right, Bird. Aha, coming back up, looking for strength. This is just a buy the stock type of trade. Hold it, set a stop, keep it back at around $6. Done. Look at us. Look at us solving problems, solving mysteries and crimes together. It's great. TPL, getting off the mat. Somebody came out the other day and said, don't buy the stock. And all it's done is gone up since then to $875 up to $975. This is a great inflation trade. This is a great company with very strong insider buying historically. So I just like the stock itself. I have bought the stock when it has crossed its 20 and its 8 EMA. 935 was around that crossover, 975. This has massive upside. It is oil and gas. It is land. It is drilling rights. And it has always had very strong insider buying. This is just something that you buy above that line, look for continued momentum and strength, take the gains as they come. This is the type of little sloped move that we are looking for all of the time. On the weakness side, play. Okay. This is still a company with its own fake cryptocurrency. It's not even a cryptocurrency. They put their money on a card and you can only spend it there. I don't like it. I hurt my back at Dave & Buster's when I was about 30. Riding that stupid horse. Not a bull, horse. The horse racing game. You know what it is. Where you have, I don't even want to talk about it. $18.03. Looking for continued weakness, just stay at the money. Buy the 1850 put, look for continued strength, or trade this volume weighted average price if it gaps up and look for a rollover down. RRR, Red Rocks Resorts, same type of thing. Again, all these consumer cyclical stocks, a lot of focus. Again, we just saw that update from Bank of America the other day saying that the lower and middle classes in America, they are tapped out. Well, I want to just point out you're not really going to find a lot of millionaires and billionaires hanging out at the old Red Rocks resorts, gambling, just not or the Dave and Buster's or the Dave and Buster's. Yeah. So crossover negative 8 on the 20, looking to continue downside. I'm not going to short the stock directly, but if you look at the options chain, if there really is much here, RRR, take a little quick gander over char. There's a Baltimore accent word you haven't heard in a while. Over char means over there. I told somebody that in my college, then they looked like me, like I was insane. Too far of a spread, 50 cents on the 60 November, unfortunately. 290 bid, 340 ask, most recent is what I'm seeing. But you might want to look for something a little bit narrower. Right now, nah. Just looking for a way to potentially short this, but I don't want to be focusing too much on things that might have too much slippage. Wayfair, though, oof. Again, another name, tariff name, a lot of worries and concerns about, again, U.S. spending. This is a glorified refund center, by the way. Just absolute mess of a company. But once again, it does very, very well in that high short interest environment. And based on what we have just seen with Wayfair, that momentum run that we have just endured, a very strong momentum run, by the way, going all the way back to the exact same point where we crossed that 50-day and have just taken off from about $31.90 up to $88. Nothing has changed in this company. I'm just going to point this out on this chart real quick. Nothing has changed. It's still unprofitable. It's still losing $300 million in income. It's still minus $21 book per share. The MACD rolled over back here, and it still has not sold off significantly. Now the question is, will the RSI and the MFI break down? Will the ADX flip? Well, actually, I like Wayfair as a short, especially if we start to see the consumer cyclical stocks really rolling over and really starting to break. Pay very close attention to want. If want, the triple bull ETF around consumer discretionary, starts to break down, Wayfair is a hell of a short. That is way too much of a rally for a stock that is not that good. All right. So on the fundamental side, you have that. Also watching on the watch list today, some other names just really quickly before we dive into the money market side. All right. So you have ASIX. What do you do? Couldn't tell you. But as we note in the runner, very simple, very critical. ASIX, what you're looking for here is a chemical name breaking out over the 20-day support at the 50-day. Your stop on ASIX is going to be back at the 1919 level. So jump over here, get back to our nice little chart there. There we go. Look at that. Very nice. Little swoop move, looking for that 8 to catch up to the 20. Play for around that 2150 level, kind of looking to retest some of that recent highs that we saw. And the MACD crossover will confirm that. GCT. And then we got one more, and this is a big one coming up. GCT looking for a continued move back. I like this, clearing the moving average. The stop is back at the $28 level. The MACD is crossing over. Looks like the histogram will turn positive and uptick. I'd be looking to try to get this back to around $38. And then finally, Delta. Do not trade through earnings. Trade to earnings. Big difference. The earnings is on Thursday. The stop is back at 56.70. There is room to 60 pre-support. If you want to buy a call, stay short duration this Friday. Buy in the money. $57.50, $57. Sell up to around the $59.60 level, and that's it. Keep a tight stop. You are looking to exit this before Thursday morning, before the company reports earnings. All right, we got 5 minutes left, and that means we have to talk about one very important thing. This is the biggest myth in the financial markets, and it absolutely drives me a little crazy. Just going to point that out. Because one of the things that somebody said the other day when this chart came out was there's $7.5 trillion in the money markets, which means there's $7.5 trillion on the sideline waiting to move into the equity markets. I have bad news for you. That's not how it works. The money's actually already in the markets. It's already in the equity markets. You just don't know it. So what you're looking at is this expectation and this view that money markets are somehow this rocket fuel that's just sitting in a tank waiting to be deployed. That's not right. This is not money sitting on the sidelines. It's actually already in the game. So money markets are basically just mutual funds, and they invest in very short-term debt. They buy treasury bills, commercial paper, certificates of deposit, and they mature in days, not weeks. It's very, very short duration. They're designed to maintain about $1 per share while they pay you interest. So they're like a savings account. They're boring and they're safe and they're liquid. At least that's what everybody thinks. Right now, you get around 4.5%. No, 4.25%, right? It turns out, though, that this money is instantly lent. This cash is instantly lent to dealers and to banks, and then they pass this cash on to hedge funds and trading desks through the repo market. Okay, so what do they do with the money? What do they do with all that borrowed money? Well, obviously, they go out and they buy Thanksgiving dinner for orphans and take care of people in need. Oh, that's not right. What is it? So they buy stocks, futures, and options, anything that can generate returns over the 4.25% that they're actually paying you in interest. So they're actually borrowing your money to trade and speculate. That is by design. So your deposit of 50 grand in the money market, you think it's safe. That money is lent to dealers and banks overnight at 4.25. Those dealers take that money to hedge funds, who then rehypothecate it. Ugh, hate that word. And they use it as collateral to buy even more. And then what they will do is they could take that $50,000 and through treasury and futures arbitrage, build that up into about $1 million in exposure, 20x. So your safe money has become a massive leveraged stock exposure. Now, this happens every day with trillions of dollars. So when they say in the media there's $7 trillion waiting to enter the market, they're actually missing the point. The money's already in the market. It's already gone through the back door into the skies. Money markets are not parking lots for cash. They're fuel stations for leverage. And every major stock rally in the past 15 years has largely accompanied cheap money market funding. So in 2009, when QE flooded money markets, hedge funds levered up. In 2020, when repos surged from 2 trillion to 4 trillion, the S&P 500 went up like 70%. 2023, repo usage collapsed from 2.5 trillion to 500 billion. It released a huge liquidity back into circulation, which led to more leverage and more rallying in 2023. And then the AI rally has coincided with repo balances going up and declines in the overnight financing rates in repo. So let me break your brain on this one a little bit, because people have asked me this question. Well, if retail traders were to take their money out of the money market and then rotate it into the stock market because they're chasing equities, where would all of the cash go? Right? Because the cash buys assets. What happens with the rest of the cash? You get 3 guesses and the first 2 don't count. It goes right back into the repo market. Because, again, the money market goes to whoever sold you the stocks. So you give them cash, they give you shares, and now they have to decide what to do with it. They either put the money back into a bank account or they put the money back into the money markets. And because the money markets are paying better yield, that's where it's going to go. You can only put cash 3 places, really: bank accounts, money market funds, and T-bills, or into someone else's account after a trade. So it doesn't disappear. It doesn't leave the system. It just moves from one owner to the other. And it's just a reminder that people are borrowing your money at 4.25% to make 15 to 20% in leveraged stock trades. And there's this view of, oh, well, people are too nervous. They're too on the sideline. Yeah, well, they think they're smart by keeping a ton of cash in the money markets. And there's nothing wrong with keeping cash in the money markets, right? But the reality is that when it comes to people are waiting for that pullback, they're waiting for that great rotation from cash to stocks, it already happened. It happened back in April. It happened back in April when we called the bottom when the insiders bought. It happened back in April when momentum turned positive on April 23rd. It happened back in May when the S&P 500 broke above its 50-day EMA for the first time in a couple of weeks, roughly 2 months. So this is the thing. The 4.25% is the VIG that Wall Street borrows from you to make double digits. And the big question is, right? Well, what's the money on the sidelines? There is no sidelines. There has been no sidelines since 2008. Your money market is not a savings account. It is a wholesale lending operation for Wall Street to pump stocks back to record highs. $7 trillion is not waiting to buy stocks. It's already bought it with massive leverage. And the question for you as a trader and an investor is, are you content making 5% by lending to Wall Street, or do you want to play the game that they are using your money for? That game, that focus, those trades, that's what we're doing every single day here, making sure that you have that edge to ensure that you are able to turn your cash into gains that top the market, beat the debasement, and bring you into a better forward-looking path with this market in at all-time highs the way it is. So that is my not rant for the day. I hope you guys have a great day. It is currently 9:21. Don is going to be up in a couple of minutes. Be back here today. I will not be back on. I have my masterclass at 2:00 with on NVIDIA. I think there's one spot left, so do me a favor, throw a 1 in the chat if you're interested. We'll get somebody from our team to give you a call, and I hope you guys have a wonderful day. I will catch up with you tomorrow, 8:45 for Market Masters. Take care.
One, two, 1, 2, 3, 4. 1.